Let's get started. What I want to do first is just update on where recordings are and so forth. If you want to go back to them, I am now able to record at a higher quality in terms of video and audio, so I'm posting that on my YouTube channel, and I'll share that link with you again. I think I did early on in the semester, but I'll send that out again just so that you know where it is. I'm putting it on a playlist so everything is in one spot. Last Tuesday's class is 720, and everything from here on out should be HD. So, and then the quality of the audio should be much better too. It won't be Zoom quality. I'm still recording through Zoom, and that'll be up in the archives on the Canvas. But if you'd rather not deal with that little tiny screen and the fuzziness and the lousy audio, you can go over to YouTube. The other thing that I wanted to make sure everybody was aware of is go over the Bloomberg. Zach was asking earlier about that. And so let me start with that. And so I need to go over here to my iPad. And as I said, I thought I was going to be able to be in the terminal itself and actually show you the BMC, but that did not work. Well, actually, I still need Safari. So let me go to bbt.youcanbook.me. So the extension is ME. And if you go there, that's where the schedule is. So right now, everything is wide open. You can just click on any of these times, put in your information, and do the I'm a human type of thing and confirm the booking. And then that's your period of time. So hopefully everyone will respect that. If you see a time blocked out and you happen to be at the physical terminal, please, please, please check this and make sure that you don't boot somebody else off that's on a remote login who has already reserved that time. I know it's a little clumsy. It's far from a perfect system, but right now it's the best that we have. So once you've done that, you've got a time set up. Some of you, if you're remote, you have to go through this portal.bloombergforeducation.com site first. If you're at the physical terminal, you don't need to do the portal.bloombergforeducation.com thing. That's only for logging in and creating your login the first time if you're remote. So for that, you go to portal. I thought it was going to come up. Oh, it's not saved in here. So that's Bloomberg for Education. .com. And I think I got that right. No, I did not. Okay, portal.bloombergforeducation.com. There we go. And so what you'll do is you'll go over here to the terminals and you will request approval to create a Bloomberg login. So that's step one. And this is only necessary, again, if you're doing this remotely and you're creating your login for the very first time. Once you've created the login in the Bloomberg terminal itself, you don't ever have to go back here. The other thing that is, what I do is once I see that you've requested permission to create a Bloomberg login, your name will show up here, and I will just flip the switch over to blue, and that will allow you to go into the Bloomberg terminal itself and create that login. And so about 25-ish of you have already done this. Some of you may have created your login already on Bloomberg itself. And you've avoided having to go through this. The other thing that I can track here is how many of you have already signed up to take the BMC using our class code. And it's very important that you all use the class code, which is in one of the first announcements. It's also on the syllabus. So if there's any doubt what that is, go back and check that out on Canvas. But right now, there are only 3 of you that have actually gone in and inputted that class code. So I'm kind of keeping an eye on both of those things. All right. So
where do we enter that?
Oh, that I'll show you. Well, I can't actually show you because I can't get into the terminal, but I'll describe it for you. So now, if whether you're remote or at the physical terminal, the next step is to go to and on the physical terminal, you just open it up and open the Bloomberg. Right. Remotely, you go to bba.bloomberg.net. And then you log in. Let's give it one more try. I see. Let's see, Andrew, you're in the lab. I don't know if there's anybody back there at the terminal or not, but we'll give it a shot and see if I can get in.
Yeah, I don't see anybody in the terminal, so I think you're good.
All right. Well, at least that's one less impediment. It doesn't necessarily guarantee that I'll get in. So here's my code, 54, what did it say, 34. And then I usually use this launch within the browser, and now I'm not getting in. Somebody else is already still using it. And that's not too surprising. We've got the CFA Challenge team. I think their deadline is actually either today or tomorrow to put in the report. So I'm not too surprised. But in any case, let me just describe. So you're here. You've already entered and installed Citrix workspace. You've put in your your initial. You've launched the Bloomberg, and then you've gone in and created a login in the Bloomberg terminal itself. Okay, so that's step 2. Step 3, I know. Step 3 is that you then go in and you sign up for the BMC within Bloomberg. So there, what you're doing, let me actually run over here to, why did that come up? Let me just show you right here. So within Bloomberg, you've got that little, oh gosh, not my day. Oh, here we go. Now it's working. So you've got that little blue box up at the top, and you just type in BMC, and you're going to get a list of possible entries that Bloomberg thinks you're looking for. Usually the first one is going to be the Bloomberg Market Concepts. And I ran out of space. All right. So just click on that. And if this is the first time that you're getting into that, it's going to ask you to create an account. And you need to type in your name. I think it'll ask for your email address again. And it will also, so you're entering name. I believe if I remember correctly, it's email address. And then down here, there's going to be a little checkbox, and that's class code. So you're going to check that box, and then it'll bring up another box that you can enter that class code. So that class code is the one that's on the syllabus, and I think it's also in one of the first announcements that I posted on Canvas. So that's where you're going to enter that. It's S something or another. I don't remember the rest of it, but you'll find it there. And then click Create. And now you're in the Bloomberg Market Concepts, you're in the Bloomberg terminal, and you're ready to go. And then you just start with one of the three modules. I would recommend starting with the terminal basics, or I think they also call it beginning with the terminal or something of that nature. But that walks you through the terminal, the window, the various things that are available to you to interface with the Bloomberg terminal itself. And then go on to the equity piece and go on to the economics module as well. So get those three done. And remember, the score that you get on this matters. It converts into course points. And for more details on that, again, look at the syllabus. So take your time, try to do as well as you can on it. And that's the Bloomberg. And then, of course, later on, we'll be using the Bloomberg to gather data for your security analysis projects. Okay, I think that covers Bloomberg, but there may be questions. Anyone have questions?
Yeah, I have one. I was trying to log into it, and I took the class code from the syllabus you put out, and it doesn't seem to work for it. I was trying earlier this morning. I went on through that portal. I did all the steps, and then I entered the class code. It said it's not associated with free Bloomberg class.
Oh, yeah. Did you, and you emailed me about that, right? Or somebody did?
It was not me.
Okay, somebody else emailed me with a similar question. I'm not sure what that is referencing. I'm going to have to dig into that. I've never seen that error before, and I'll double check what's going on there. Could be that I've got it wrong in terms of either on the syllabus or on the announcement. I'll check that first. I usually just copy and paste to avoid that sort of error. But I know that there are at least three of you that got into it, so somewhere something is copacetic, but I'll go back and confirm that. Thanks, James.
That happened to me before. I think we were just entering in the wrong spot because I don't think I could get into the spot where we're supposed to do it.
Okay. Now, so maybe you were using, let me go back to this portal.bloomberg4education.com. So over here, there is a spot, and I believe it's I thought it was there. Maybe if you're going into it this way. There's a spot over here when you're signing in to get approval for the for a Bloomberg login that kind of prompts you and says, "Hey, do you want to sign up for the BMC?" And that one is what's puzzling me is that you're getting a message saying it's not valid for the free BMC, but there is a prompt when you log in here that asks you if you want to sign up for the $149 version of the BMC. Same BMC, it's just that it's done through a regular web browser instead of through the Bloomberg terminal itself. I don't see the link here though, but that may be it too. Was that where you saw it, Sean?
Yeah, that's where it was like $150. That's where I tried it, but I don't know if that's where we're supposed to do it or not.
No, it is not. So the only way that I want you all to be doing the Bloomberg Market Concepts is within the context of the terminal. So you've got to be in the terminal itself, whether you're on that physical terminal or logging in remotely. You're in that terminal, and you're then going through the Bloomberg Market Concepts within that program, not through just a regular web browser interface. So, like I mentioned this earlier, but it probably didn't make sense at the beginning of class. There are two ways to do Bloomberg Market Concepts. If you don't have a Bloomberg terminal or access to one, for $149 or $150, you can do that through a regular web browser window. If you do have access to the Bloomberg terminal, which we all do, either remotely or physically, you can do it through the terminal itself for free. So make sure it's that latter version. But I'll look into making sure that I've got the code correct in all the locations that I have it in Canvas. Other questions about Bloomberg or the BMC? So everybody make an attempt to get in there before the end of the weekend. All right. If you are on campus or close enough to campus that you can go into the physical terminal, I'd recommend doing that. It's just a lot easier. The remote access is still clunky. I don't know why Bloomberg can't get that straightened out. My guess is that for their commercial and professional customers, it's not a problem because it's one person, one terminal, one login. It's something about us having multiple logins and people working through one terminal that creates the problem for them, and they've kind of shoehorned us into this because of COVID. And we're not a big revenue generator for Bloomberg, so they deal with us when they have time. Anyway, I think that's it for Bloomberg. Any other questions in general? Want to also give you an update on the midterm. So we talked last class about the midterm coming up in 2 weeks. So looking at the schedule, what I want to talk about in class, what I want to do. And I think rather than trying to put the midterm on Tuesday of week after next, I'm going to, at the very earliest, it will be that Thursday. All right, so that gives us one additional class period. That gives you guys a couple of extra days as well for study. So today what I'd like to do is to finish up talking about Chapter 6 and then get into working some problems. So some of this, or most of this, is going to be just a review of what you've already done in the homework. But I'd like to do it in the class setting and try to take any questions and make sure that you've got a thorough understanding. Repetition is also important when it comes to learning, so you're going to be seeing it again, and we're going to be walking through it as a group. So we'll do that today. Next week, I'm going to do just a very short bit of lecture on chapters 19 and 20. Those should be relatively basic stuff for most of you. Coming out of, you've already had Accounting 201, 202. Some of you may already have had Accounting 310 if you're a finance major. And that material relates more to Chapter 19. The material out of Chapter 20 is more related to money and banking and to the institutions, the financial institutions class. So that's EC 311 and FN 316. So if you've had those classes, those chapters make a whole lot more sense. They're really a repetition. But I wanted to make sure that just in case you haven't had those classes yet, that those chapters are there. So don't ignore them. They're very important, but I'm not going to spend a lot of time on lecture. I'm going to pick and choose very carefully which items I want to emphasize, and I'll discuss those briefly. But most of next week we'll spend on Chapter 5, which is the stock market, and we'll also finish up working through some problems. And then that should give you a good grounding for the midterm. All right. Oh, yes, Julia.
I was looking on the Canvas homepage, and it says that the midterm exam is March 2nd, but is it now going to be the 25th?
Yes. I apologize for that. I haven't updated that. Let me check my calendar here.
Yeah, just the homepage of Canvas says.
Yeah. Down in that grid with dates. Yeah. It is I'm planning on the 25th. There's some possibility that we may push it off to the 2nd. I'm less about covering material. I want you all to understand the material. So we'll see how that goes, but worst case scenario in terms of the earliest date will be the 25th. The latest date will be the 2nd.
Thank you.
All right, so let me shift over here, and let's get to PowerPoint. So we left off the H model in the last class lecture because I had the wrong slide in there, so I fixed that slide. And so here is the H model. The idea here is most easily understood by looking at this graphic. So they've laid this out so that we're looking at the two parts of the formula. All right, so if you go back here, you'll see these two terms out of that formula. They're mirrored right here. So let's deal with this one first, this blue one. This is simply exactly like our constant perpetual growth dividend discount model, right? And so we've got some growth rate G2, and we're valuing the firm based upon that G2 rate from time 0 to infinity. All right, so that encompasses this blue box. That's the value generated out of this term, out of that H model. The second, or the other term, in fact, it is the second term here. The second term gives us the value for this orange triangle piece. So this is that half-life, if you will. So rather than doing something like the two-stage would show, we'd be going along here at growth rate G1 right until time t, and then it would drop down to G2 on out to forever. But the H model says, well, you know, that's not very realistic. That's a step function. Let's try to model this more realistically. Let's make it a linear transformation from the high rate down to the lower long-term rate. We could also, you know, if we have a negative growth rate, you would see that orange box actually subtracting value here, and it would come up this way. But this example is assuming a supernormal G1, a much higher G1 rate. So that's the H model, and the formula is here. That for some reason they didn't put this formula in the book. I'm going to add this to the formula sheet for the midterm, so you'll have it. And again, it's kind of more or less just a plug and chug. The only difference here is this H notation, which comes into play right up there. And H is simply the high growth rate, the high growth rate period divided by 2. So if the high growth rate period, if T is equal to 3, H is equal to 1.5. So we have the high growth rate for 3 years. The H then would be 1.5. If the high growth rate is 4 years, the H is 2. And the rest of it is just plugging in the appropriate numbers and chugging through a number, and it'll give us this sort of model, as opposed to that two-stage, which is simply a step function. All right? Any questions on that? Okay. So where we left off on Tuesday was right over here. And so I've got a number of Professor Damodaran's videos posted in the resources under chapter 2, I believe, or week 2, I believe, on the Canvas page. And so I strongly recommend you watch those. I do want to spend about 10 minutes with us watching together this particular video. He's going to be talking about relative valuation, and he does an excellent job of describing it. The rest of his videos are very similar to this, and I'd strongly recommend that if you've got 10 or 15 minutes and you're sitting around waiting on something else, go through these. It's going to help you immensely when it comes to going through the security analysis and doing valuations. And it'll probably even help improve your understanding for the midterm. I don't think it's necessary that you go through all of them before the midterm, but it is wouldn't be a bad idea if you've got the time. So let me hit the button here. And,
valuation. I should also tell you.
Okay, audio is working for you all right? Okay, let me grab my audio since I can't hear it through the speakers. Oh, great. Murphy's Law. I had Bluetooth headphones that were charged, and they don't seem to be charged anymore. Let me try this one more time. Darn it. Oh well. Let me see if they even show up. Come on. No, they're not going to play nice. I'm going to play the video anyway. I know about where to stop here. So let's go ahead with it.
That relative valuation is pervasive. It's all around us. In fact, to show you how pervasive it is, I'll give you a couple of statistics. About a decade ago, I collected about 550 equity research reports from around the globe, different investment banks, different equity research houses. I must confess, I didn't read most of them. I collected them because I wanted to categorize how equity research analysts approach valuation. Out of the 550 equity research reports, about 45 were discounted cash flow valuations, less than 10%. About 450 were relative valuations, a multiple and comparables. The remaining 55 were kind of fuzzy. I couldn't quite categorize them. But among the ones I could categorize, 10 to 1, relative valuations outnumbered discounted cash flow valuations. I took a look at about 100 acquisition valuations, hoping or expecting things to be different in corporate finance. Out of the 100 acquisition valuations, I got a much more even split. About half were discounted cash flow valuations, half were relative valuations. But then I took a closer look at the half that were discounted cash flow valuations, and I noticed that in most of them, the biggest number, the terminal value, was estimated using a multiple. So even those were really relative valuations. Almost every rule of thumb you see out there is based on a multiple, right? What am I talking about? Price to book less than 1 is cheap. A price earnings less than 10 is cheap. They're all based on multiples. What I'm trying to say is the language of valuation around us is the language of relative valuation. So when I first ran this statistic, I was a little puzzled by my finding, and here's why. When I teach my valuation class at NYU, I always end every class with a question. And this is after everybody's valued their companies using multiple approaches, discounted cash flow valuation, relative valuation, whatever other approaches they might use. So I asked them at the end of the class, after they've tried these approaches, if they had to pick an approach, which one they would pick as their preferred valuation approach. In the 25 years I've taught the class, I get pretty much the same answer. About 70% pick discounted cash flow valuation or intrinsic valuation, reflecting, I guess, my biases. About 20% pick relative valuation, and about 10% are not quite sure. So 7 to 2, when people leave my room, they say they're going to use discounted cash flow valuation. I haven't done a follow-up questionnaire, but if I did a follow-up question 5 years later and asked these people on their jobs, I don't know what jobs they're at, what approach do you use to value companies? I'll wager the numbers get switched. That 70% use relative valuation and maybe 20%, maybe, still use intrinsic valuation. So I started thinking about what it is about relative valuation that makes it so attractive to analysts. And I've come up with 3 possible answers, and feel free to add to this list. The first one came to me while I was watching a Seinfeld episode. One of those episodes where one of
most of you probably
Jerry's
don't
many
know the
girlfriends
Seinfeld
accuses him
reference,
of being
but that's
crazy.
all right.
Jerry, you're crazy. He says, if you think I'm crazy, you should see the guy who lives across the hall from me. And if you've ever seen a Seinfeld episode, you know who lives across the hall from Jerry, right? It's Kramer. And relative Kramer, who's crazy? You're saying, what's this got to do with relative valuation? We forget how much of valuation is selling, right? So if you're trying to sell me something, it's far easier to sell me something with a relative valuation than an intrinsic valuation, because here's all you need to do. You need to find something even more overvalued than what you're selling me. You say, look, it's cheap. It's cheap relative to these 5 other things I found out there. Relative valuations are far easier to sell than intrinsic valuations, because as long as you let me pick the multiple and you let me pick the comparables, I can tell you whatever story I want to tell you. Second, it's far easier to defend a relative valuation than an intrinsic valuation. And here's why. In intrinsic valuation, your assumptions are all explicit. Everybody can see what you're assuming about cash flows and growth and risk, and that's dangerous because they can pick it apart. In relative valuation, all your assumptions are implicit. So when you use 12 times EBITDA, you are making assumptions, but nobody can see what those assumptions are. And if they cannot see them, how can they pick them apart? And third, and this is something that we don't factor in enough when we think about valuation. I personally think in the long term, you're far more likely to be right with intrinsic valuation than relative valuation. But here's the catch. When you're wrong with intrinsic valuation, you're also far more likely to be wrong alone. You're saying, so what? If you're wrong alone, you tend to be fired. If you use relative valuation and you're wrong, you're always going to have lots of company. And that's a safe place to be. The survival instinct kicks in, and that's why I think more people use multiples than intrinsic valuation. Even if you're a true believer in intrinsic valuation, here's my advice to you. Understand relative valuation. Keep it in your arsenal. It doesn't have to be an either or. I am a true believer in intrinsic valuation, but I still do relative valuation. I'll often frame my intrinsic valuation in terms of relative value. So don't give up on relative valuation. So let's talk a little bit about how we can bring relative valuation into our toolkits. Before I talk about the 4 basic propositions or ways in which you can prevent yourself from making mistakes with relative valuation, let me first go back and talk a little bit about multiples. As I said, to make comparisons across companies, you got to use a multiple. And every multiple is a numerator and a denominator. And here's the way to think about it. In your numerator, you almost always need a measure of market value. That market value can be just of your equity, that's market cap, as is the case with price-earnings ratios. It can be market value of equity plus the value of debt, which is the market value of the firm. It can be market value of equity plus debt minus cash. That's called enterprise value. So in almost every multiple, you're going to see one of those 3 numbers: market cap, value of the firm, or enterprise value. The difference between enterprise value and firm value is enterprise value is net of cash. So it's firm value minus cash. In the denominator, you can see one of 4 measures. You can see revenues because you're wary about accountants and what they can do to the bottom line numbers. You might see earnings per share, operating income. You might see even measures of cash earnings, EBITDA. You might see book value of equity or book value of the entire firm, or you might see some sector-specific measure. What am I talking about? Remember the late 1990s when .com companies were compared based on value per website visitor? You can compare steel companies by dividing the market value by the number of tons of steel they produce. But basically it could be some measure of operations, market value per employee, market value per unit output. But in all of these measures, what you're trying to do is you're trying to scale market value to some common variable. That's the first step in relative valuation, is to get a sense of what those multiples are. Because I'm going to take you through a 4-step process that if you're religious about following, you're going to be okay with relative valuation. Because my problem with relative valuation is not that people use it, but that they're shoddy about the way they use it. And here are the 4 steps I'm going to go through. I'm going to start off by defining the multiple.
I want to jump in here quick. These 4 steps, pay close attention and please follow up once we're done. I'm going to let him discuss that first step, but then I want you to go back and look at steps 3 and 4, or 2, 3, and 4 on your own. So here we go.
I mean to be insulting. You're probably saying, I know what the PE ratio is. I know you do. But your definition of PE and my definition of PE might be very different. I'm going to describe the multiple. Sounds fancy, right? But I'm going to use Stat 101. I'm going to put up a histogram. I'm going to count the number of companies with PE ratios between 0 and 4, 4 to 8, 8 to 12, put it on a distribution. Because the distribution is going to tell you some very interesting statistical things about multiples. Then I'm going to analyze the multiple. I'm going to argue that embedded in every multiple are all of the assumptions you made in discounted cash flow valuation about cash flows, growth, and risk. I'm going to make your implicit assumptions into explicit assumptions. And only then am I going to apply the multiple. Define, describe, analyze, apply. In too many cases, you see analysts trying to apply a multiple without going through the first 3 steps, and that's what gets you into trouble. Let's start with defining the multiple. When I look at a multiple, there are 2 basic questions I ask. The first question I ask is this multiple consistently defined? Let me explain. As I said, every multiple has a numerator and a denominator. If your numerator is an equity value, your denominator has to be an equity value as well. If your numerator is a firm or an enterprise value, your denominator has to be a firm or an enterprise value as well. You have no idea what I'm talking about, right? Let me back up. Let's take PE ratios. Think of what's in the numerator. It's a market value of equity, right? And in the denominator of earnings per share, which is equity earnings divided by the number of shares, which is okay. Thank God for small blessings. The most widely used multiple in the world is consistent. Or EV to EBITDA. In the numerator, you have market value of equity plus debt minus cash, a rough measure of the market value of the operating assets in the company. And in the denominator, you have earnings before interest, taxes, depreciation, and amortization, a rough measure of operating cash flows. EV to EBITDA is okay. So here's what's not consistent, a price to EBITDA ratio. And here's why it's not consistent. Your price is a market value of equity. EBITDA is an operating cash flow. You say, what's wrong if I use it and I'm consistent? I use it for all 15, 20 companies in my sector. It's still not going to work. And here's why. If you have companies that borrow a lot of money, let's say they borrow money to buy back stock, their market value of equity will drop, right? But their EBITDA will not be affected by the borrowing. Those companies are going to look cheap to you. If you mismatch your numerator and your denominator, use equity value in the numerator and use a pre-debt value in the denominator, you're going to find companies that borrow a lot of money look cheap to you for all the wrong reasons. So check your multiple to make sure it's internally consistent. Second, make sure it's estimated exactly the same way for all 15 companies in your sector. It's actually a tougher test to meet than it sounds. If using price-earnings ratios, here's what I'm asking you. Is earnings per share estimated exactly the same way for all 15 companies? That doesn't just require that you have the same accounting standards, right? You need all companies to have the same amount of fidelity to those accounting standards. If they don't, aggressive companies are going to look cheap to you. So watch out. Second step in the process, describe the multiple. As I said, this is basic statistics. When you have a lot of data.
All right, so I'm going to jump back in and leave the rest of this video for you all to watch, but I wanted to catch this first 10 minutes to just get some sense of the value that he brings. This whole series is really great, and I strongly recommend that you watch as much of it as you can. So let's go back to the slides here. So talked about a number of things. We're going to review some of that as well. So he was talking about, let me go back here so that you can see these. PE in particular, right? Oops, hang on just one second. Let me get my desktop organized. So price to earnings, as he said, thank goodness that it's the most widely used ratio is a consistent ratio. So the price per share is the price per share of equity, and the denominator is the earnings per share, which is the earnings that accrue to the equity stakeholders. The inverse of that, of course, is earnings yield. And we also use, quite frequently, we'll look at, or we'll use the terms growth stocks and value stocks for defining high PE versus low PE stocks. And you'll see in just a minute, I'll prove to you that those labels that are used for high PE versus low PE do make sense. We've got price to cash flow is another widely used ratio. Most finance people would argue that it's a better ratio than price to earnings. And that is exactly what Professor Damodaran was talking about when he said not each company has the same fidelity to the accounting standards. There's a lot of wiggle room in these standards, and one accountant might interpret it one way and another way, and that could cause the earnings of a company that has the same cash flows could cause their earnings to be different. So cash flows are less able to be manipulated, or and I don't say manipulated in a derogatory term. They're less they have less flexibility to be changed based upon your interpretation of accounting rules. So price to cash flow is something that we pay a lot of attention to. Interestingly enough, though, Wall Street and practitioners don't pay as much attention to it. Part of the reason is probably it just takes a little more effort to calculate cash flow. It's not something that's right out there, that's always at the bottom of the income statement that everybody posts. But it's becoming more accepted and more widely reported. So that should make it easier to use price to cash flow. Price to sales. Now, in Professor Damodaran's parlance, this is an inconsistent ratio, right? So I always think about, we're looking at the income statement, and we're up here at the top. We work our way down to the bottom, and we have net income. At the very top is revenue. And there are various claimants all the way down here that take their piece of the pie. Obviously, it's suppliers for cost of goods, it's wages to employees, things of that nature that come out right here. Well, to the extent that those costs vary from one firm to another, in other words, they have different cost structures, that's going to mean that what's left over here, this residual piece that goes to equity, is going to be a different percent of the original revenue. So if we're looking at a ratio that just is price of equity over revenue, that can be problematic. Now, if we were to control for all of the firms and analyze their cost structure and say, oh, they're identical, then you might be okay. But that's a heck of a lot of effort. Why do we have this ratio when we could just use PE or price to cash flow? The answer is back to, again, what Professor Damodaran was saying. I know most of you don't remember the late 90s dot-com bubble, but there were many firms that the only positive value on their income statement was revenue. By the time you got down to gross profits or operating profits, it was a loss. And that's because they were startups. So they were burning through a lot of cash to get into a period that hopefully in the future they would be profitable, right? So that's why this ratio gets used sometimes, is that if you don't have a positive value any lower down on the income statement, well, what else can you use? So we use it, or the street uses it. Price to book is another interesting ratio. And again, that has its foibles as well. Price to book, though, is consistent. And that's because we are looking at the price per share, that's equity. And we're looking at the book value per share of equity also. Typically, a price to book ratio is greater than 1. And oftentimes it's on the order of 3 or 4. Very rarely do you see it going into double digits. The other thing to note about price to book, this is also known as market to book, right? Or M/B. Again, some idiosyncrasy, depending on where you went to school. Sometimes people will invert that and they'll talk about the book to market ratio. And obviously that's inverting that ratio, so less than 1 is what you'll typically find in a book to market ratio. So be careful when you're looking at this ratio. Depending on who you're talking to and where they went to school, it's either going to be market to book, which is going to be greater than 1 typically, or it's going to be book to market. Here are a few examples that your authors give you in terms of how to actually implement some sort of very simplistic relative valuation. And one of the things that they're doing here I want to mention, they're looking at the company itself as a comparable. So what they're doing here is they're saying, well, why don't we use the company itself? It's the best comparable. It's the best peer because, hey, it was that company a year ago or 2 years ago or 3 years ago. And so that's compelling for sure. The problem is twofold. One, we got to make sure that it truly was that company. There are a couple of things that could have made it a different company in years past. We could have had a lot of acquisitions going on over that period. So today, the company is a very different company because we've acquired other companies going along the way. And the second thing actually encompasses the first issue, and that is the asset portfolio of similar risk to what it was in years past? And how do we change the riskiness of the portfolio? We could substitute assets. We could sell one set of assets and replace it with higher risk assets or replace it with lower risk assets. And we could also do that through acquisition by acquiring either higher or lower risk assets. And that's going to change the overall riskiness of the asset portfolio. So always think of the asset base of a company as just a portfolio of individual assets. So that's the downside to using the company itself as a proxy. The other downside to that is that that's a historical ratio. That's how the market valued earnings or cash flows or book value of equity or whatever the denominator happens to be. That's how the market valued that 1 year, 2 year, 3 year, 4 years ago. Now, I'm not necessarily saying that the market is overvalued. It could be, or it could be undervalued. So there could be some inefficiency in the market price itself. There could be a bubble market or the reverse of that. Immediately after a bubble pops, if you believe in bubbles to begin with, usually you think of the subsequent market as usually undervalued. But there's even if you believe that markets can never have an inefficient price, we could still have a change in the overall risk averseness or risk tolerance of the investing public. And that could shift how we value earnings or cash flows or book value of equity. So using the historical average for the company itself has some attractive pieces to it, but it also has a lot of problems. My preference is that we find some peers and we get the average peer ratio. So although your authors use this as an example and use the company itself, recognize that a much cleaner, much more efficacious method is to figure out what are the peers to Intel and use those peers and use their current ratios, because that gets around that problem that we're not factoring in any shifts in risk tolerance of investors, or if you believe in market inefficiency, any over or under valuations that are in the marketplace. Okay, but the technique, though, or at least the example still follows. So if I have an average PE, whether it's historical or from my current peers, of 15.9, so that's P over E, and I have an earnings per share of $3.22 that just was reported. Now remember, I'm always looking forward, so I always need to grow that earnings by some growth rate. Here we're estimating the growth rate of earnings to be 0.9%. So here's the formula. I take my PE, so that's P over E, and I multiply it by the future earnings, next year's earnings, so that's $3.22 from this most recent year, times 1.009, so that's reflecting the growth rate, and I come up with an earnings here. Obviously, E cancels the E, and I'm left with a price. So there's a price estimate, and I compare that to my market price. So I have $47.30 in the market. I have 51.66 using this particular ratio, using the 5-year historical average for Intel itself. That's relatively close. My guess would be that we would have a neutral recommendation if this were our sole factor that we're analyzing. Then if we go on and look at price to cash flow, again, using the same historical measure instead of a peer analysis at the current time, they come up with a price to cash flow ratio of 8.8, and the current cash flow per share is 306, and those cash flows are expected to grow at 2.2%. Plug all of that in down here, and we end up with a estimated value of $27.52, considerably lower than the market price. And given that we believe that cash flows are more relevant, efficacious measure, less suspect to manipulation or variation from firm to firm based upon fidelity to the accounting standards, we might say, this thing looks like it's a little bit overvalued, possibly. And we could go on and do a price to sales. Now, remembering that this ratio is inconsistent. The first two were consistent, but again, the same thing, 3.1, 14.7 in sales, and 3.1% expected growth. We come up with an estimate that is extremely close to the current value. Now, one's tempted to say, oh, I've got 3 valuations. 2 of them are very close. The other one's a little bit farther away. I'm going to take an average and say that this thing is about reasonably valued. So my recommendation is a hold. That's probably a flawed way to look at it. We'll talk about why in a little bit. Okay, so enterprise values are a very commonly used measure, and Professor Damodaran mentioned those. One thing he didn't mention about enterprise value is why subtract the cash out. You might be thinking, gee, I mean, a company has cash on its balance sheet. And what we really mean when we subtract cash out, we're really saying not all cash. We only want to subtract out excess cash, cash that is not necessary to operate the firm, usually on a quarterly basis. So we're going to have some disparities between cash inflow and cash outflow on a daily and a weekly basis. But over a year, for sure, those have to we have to have more cash inflow than cash outflow eventually, right? But at any given period of time, we may have greater cash outflow than inflow. So we need some cash balance in order to keep the company operating. That cash is cash that we don't subtract out when we estimate enterprise value. It's the extra pile of cash that's sitting out there. Why do we have an extra pile of cash sitting out there? In the case of Apple, one could argue that they've got that huge pile of cash, billions of dollars, sitting out there because they're trying to avoid taxes. The more typical reason that a company might have a big pile of cash sitting out there, and when I say cash, it's not necessarily just in dollars. It could be in very liquid securities like bonds, treasuries, things like that. Obviously, you're not just going to leave cash there. You want to earn something off of it. But the other reason that you might want to have cash is that maybe you're a startup and you know that you're going to have a negative earnings for some period of time. We call that a burn rate. You're going to burn through cash before your earnings turn positive for at least a year, maybe 2 or 3 or 4 years, depending upon the company and the market and so forth. So you need this pile of cash in order to get from where you are today to a point of time when you actually start having positive earnings. That's the cash that we're talking about subtracting out, because in those cases, it's not necessary for the current ongoing operation of the firm. It's just cash. So what's it worth? It's worth what cash is worth. So we don't need to account for it. Makes it a lot simpler. So enterprise value, subtract off the excess cash. And then we're just left with the assets that are actually used in the current operation of the firm. And again, as Professor Damodaran mentioned, enterprise value to EBITDA is a consistent ratio. And here's an example of how we would work through this. If we have equity worth 800 million, we give a market value of debt of 300 million. And remember, both of these are market values. Very important. It's tempting to just look at the book value of debt because it's there and that's what we issued it for, but that's not what we want to use. We want the market value of debt because interest rates have changed, and that changes the value of the bond portfolio. And then we have excess cash of 100 million. So the enterprise value is the equity plus the debt minus the cash. So we end up with an enterprise value of right at $1 billion. Then in terms of EBITDA, that is right down here. Before we subtract off depreciation and amortization, before we subtract off interest, and before we subtract off taxes. And so when we do the ratio EV to EBITDA, we end up with a ratio of 5. And again, that's a consistent ratio. But remember, if we want to get to the equity value, we still have a little bit of work to do. So let's say that we have a industry average of EV. Sorry, that should be EV. Scratch that. I'll fix that in the slides. That should be EV to EBITDA. For the industry is 6. We've got a corporation that has an EBITDA of 50 million. So QWERTY Corporation has 50 million in EBITDA. And we're going to multiply that 50 million by the industry average ratio of 6 to come up with an enterprise value for QWERTY of 300 million. So how do we convert that to what's the equity worth for QWERTY? Well, they have 75 million in debt, 25 million in cash. So remember, we had EV is equal to equity plus debt minus cash. So now we're trying to find out what equity is worth. So it's equity, EV minus debt plus cash. All right. So we start with the 300 million, we subtract off the 75 million, and we add back the 25 million, and we end up with 250 million for the equity value of QWERTY Corporation. And that's just same sort of technique originally to get the enterprise value, but unlike the PE or the price to cash flow, we have to do a bit more work to actually get to the value of equity itself because enterprise value includes both debt and equity. In terms of measuring PE, again, Professor Damodaran mentioned that, and there are a couple of different ways you can start measuring this. And again, you want to make sure that whatever PE you're using, that you're using the same PE for all of the companies that you're gathering the ratio for. So even the numerator could be something other than just the current price. It could be the average over the course of the year. Why the average, you might ask? Well, because actually the earnings occur over the course of the year. Why are we taking a snapshot of price? All right. So some could argue that this is a more accurate measure of price. And then earnings for sure vary depending upon what you choose. You could use the most recent financial year. You could use the trailing 12 months. TTM is also the abbreviation that you see often. That means trailing 12 months. Or you could use a forecast of EPS. Now, obviously, if you're using a forecast of EPS to calculate your PE, you're going to get very different measures than somebody else using their forecast because your forecasts are probably going to vary. However, the forecast PE is really what you want. Both the first two, either the most recent financial year or the trailing 12 months, are historical. They're backward looking. So we really don't want that. A pure PE ratio is going to use the forward-looking earnings because remember, price here, especially if you're using current price, it's forward-looking, right? So we really need to have this ratio truly consistent, not only in that the numerator and the denominator agree in terms of who the stakeholder is, but also in whether we're looking back or whether we're looking forward. We need that agreement too. So a truly consistent PE ratio would be the current price and the forecast earnings. But of course, that takes a heck of a lot more effort, and you're going to get a lot different PEs from your fellow analysts and others that are estimating that figure because your earnings forecasts are going to vary as well. So as you see, once you dig into this, and you yourselves are going to get into this when we do the security analysis, it's a lot less cut and dried than homework problems. I guarantee you. And I got rid of my my notation here when I got in and out of the spreadsheet or in and out of the PowerPoint. Here's another really interesting thing. We can actually look at PE as a function of growth, discount rate, and the payout ratio or the retention ratio. So remember back to the dividend discount model with the constant perpetual growth assumption. It was simply the next period's dividends per share divided by the discount rate or the cost of capital or the required rate of return, whatever term you want to use there, that K, minus the growth rate of dividends. And so why don't we plug that in for price and do a little bit of algebraic manipulation? We end up with PE can actually be restated as a function of the payout ratio, the growth rate. By the way, that's 1 plus the growth rate. And growth rate's down here too. And then the discount rate. So if we look at it in those terms, we'll find that higher growth firms or firms with a higher G, they will have higher PE ratios. Low growth firms will have low PE ratios. Remember what I was talking about when we looked at growth firms being defined as high PE companies? This is why. Low PE companies are defined as or called value firms or value investing. High risk firms tend to have lower PEs. So when you look at PE and forgetting about these other factors, and you say, oh, a low PE, I'm paying less per dollar's worth of earnings. I'm going to buy that thing because it's cheap. Oh, it might just be riskier. Now you're buying a risky portfolio. So be careful. I mean, I know that Warren Buffett likes value investing. Graham and Dodd, of course, introduced Warren Buffett to value investing. But it's not as easy as just finding low PE firms. You've got to control for things like risk. Also, firms with lower reinvestment needs, in other words, they have a higher payout ratio, have higher PEs. So again, even the payout makes a difference. So what's the dividend, or how much do they repurchase of their shares? If we look at this using a spreadsheet, we can actually show this analytically. Here we are. So this formula right here is embedded in the spreadsheet here. All right. So now, if I want to change, if I want to look at growth rate, remember I've got the PE down here. Yeah, come on, behave again. There's my PE. So watch what happens when I change growth rate. So let's make growth rate. Keyboard here. And even this is not cooperating with me. Darn it. Come on. All right, maybe this will work. There we go. So when I make growth rate 0.08 rather than 6%, notice what happens to my PE. It goes up to 8. Likewise, if I make my firm riskier by increasing the K, make it 0.15, PE drops. So I can verify empirically that what I'm finding or what I'm stating in the slide deck is indeed true. And let's get back to, where did our PowerPoint go? Okay. Sorry, that was far from seamless. All right. PE over time. That's kind of an interesting thing to look at here as well. We see that back during the dot-com bubble, late 90s, early 2000s, we had a peak. Obviously, during the financial crisis, we also had a peak. By the way, this is the S&P 500 firms, and this is a trailing 12 months earnings over the current price. And look at where we are right now. I just updated this slide earlier this morning. Look where we are with the PE for the S&P 500. That is an unusually high PE. Look, historically, we're going back to 1800s. So that should cause us to have some pause. Now, I'm not saying go out and short the market. Please don't interpret that. But I am saying, that's getting up there. Really seems inflated. Now, what that really could be saying, though, instead of the market's overvalued, it could be saying that we are using historical earnings and that forecast earnings are much higher, which is going to bring that ratio down, much more in line with kind of this long-run historical average that we see. Somewhere in the high teens or low 20s is much more typical. But, we're using that historical earnings figure. I'll bet you if you go out there and look at forecast earnings, those are much higher than the trailing 12 months. So it could be just an aberration related to, timing of our earnings figures. All right, so averaging multiples, as I mentioned earlier, that is fraught with potential for problems. Basically, you're throwing in the good with the bad. And really, as an analyst, what you're bringing to the table, the value you're bringing to the table is analysis, your knowledge about this. So why just mush everything together? I can have a computer do that. I don't need an analyst for that. Bring some knowledge to the table and say, I've studied these ratios. And as Professor Damodaran mentioned, you're going to look at the distribution of these ratios over time and currently within the industry as well, and get a much better context for what's going on. And so you don't have to just mush them all together. Probably a better way is to use some sort of weighted average. If you insist on using more than just one, which is okay, as long as you think multiple ratios have some validity and value that they're bringing, but you might weight them differently. So the ones that you're more confident in, you put a higher weight on. The ones that you're less confident in, you put a lower weight on. Some of them you leave out entirely. So you're putting a 0 weight on them. And like I said earlier, you could just pick a single multiple. That's another alternative. I'm not going to go through this exercise in any detail, but I would recommend that you go through this at the back of the chapter and make sure that you understand this. They look at using dividend discount model. They look at using residual income model. They look at doing relative valuations and the free cash flow models and things of that nature. And they're just using this one firm, CVS. So they're pulling out data, calculating a cost of capital here, assuming that the market risk premium is 7%. And notice that the risk-free rate is not the current risk-free rate. It's an average over a long period of time. So that's about 3% here. And they've got a beta that was calculated by Yahoo Finance of 1.03. And then if we apply that into the dividend discount model, first we're also going to need a growth rate. So we look at retention rate and we look at ROE. We multiply one by the other, and that becomes our sustainable growth rate. Now remember, there are assumptions behind sustainable growth rate, and those assumptions are that we are not growing the firm in other ways using outside capital. So we're not issuing new stock, we're not issuing new bonds. The only way we're allowing the firm to grow, or the assumption that we're making when we use sustainable growth, is that it grows from organic cash flow, that is, cash flow that the firm itself generates. When we use that information, that K of 10.2%, retention ratio of 0.34, and an ROE of 8.71, which gives us a growth rate of 2.98, plug and chug into the constant perpetual growth dividend discount model, and we come up with a value of 28.49. And then we compare that again to the current market price, which is 66.82. And then they also come up with a series of prices which they suggest that you all, and I also reiterate that suggestion, that you all go through the same sort of gymnastics and calculate on your own, verify. Here we use two-stage dividend discount. Here we're using RIM with different forecast growth rates, free cash flow model, and then we get down here into the relative valuation techniques. And they come up with a variety of prices, everything from 118 down to a low of about 24.74. That's a pretty wide spread. And so really the value that you're bringing to this as an analyst is which of these is more credible? Which of these is a more valuable estimate? And that's pretty much it out of Chapter 6. I see that we're running really tight on time. We're not going to be able to get into the exercises yet. First thing Tuesday, though, we will. So Tuesday, make sure that you have a financial calculator handy at your desk, and we'll start on to some of the exercises. Also, take a look at the website. I'm going to update it with additional slides. So lecture slides will be there. I'm also going to post a formula sheet for the midterm. So it'll show you all the formulas that are on there. I'd recommend that you look at that ahead of time. If you have any questions, if you see any errors, let me know. I'm going to provide that to you on the midterm itself. So you will have access to it, but make sure that you've looked at it first so that you understand the terminology and so forth. Other questions? All right. Don't forget the homework, Chapter 5 on Monday, and a couple of homeworks. I think I assigned Chapter 6 and 19, and then we'll pick up that last homework on Chapter 20 the following Monday. And that'll complete all of the material for the midterm. And I think that's it. I will see you all on Tuesday. Have a great weekend. Study hard. Bye-bye.
Thank you.
Thank you.
Thank you.
Bye-bye.